Working through some chapter 4 sample problems here. This chapter looks at the very last step in the accounting cycle. After financial statements are prepared, we want to prepare the general ledger to start recording transactions of the new accounting period. That means we need to close out the temporary accounts. The temporary accounts, remember, are revenue, expense, and then the owner's drawing accounts. So looking at this first problem, the ledger of Swan Company contains the following balances. At the end of the accounting period, the capital account has $30,000, drawing account has a balance of $2,000, service revenue $50,000, and then $27,000 in the salaries and $4,000 in the supplies expense accounts. The very first closing entry will close out the revenue account. Currently, the revenue account has $50,000 balance. Revenues have a credit balance. If we want to close out the revenue account, we need to debit it. So we will debit the service revenue account to close out its balance. We transfer that balance to a temporary account that we use only during the closing process. That account is called income summary. Debiting the revenue account, crediting the income summary. This, in effect, transfers the total amount of revenues over to this income summary account. Second closing entry, close out the expense accounts. Two expense accounts. Expense accounts have a debit balance. To close out debit balances, we would credit each of those accounts. So our second closing entry will credit salaries and supplies expense accounts for their balances. Crediting those accounts, we have zeroed them out. We will transfer the total amount of all expenses to the income summary account with a debit. After those first two closing entries, we will have credited the income summary revenues and debited income summary expenses. The difference between the revenue total that we transferred and the expense totals that we transferred leaves that account with a credit balance. Because the first entry credited it 50, second entry debited it 31, leaving it with a credit balance of 19,000, the difference between the credits and the debits. Our third closing entry will then close out the income summary account. What we did is summarize the income in the income summary account. It was left with a credit balance of 19,000. To close out that credit balance, we are going to debit that account. By debiting income summary, we are transferring the total amount of income out to the capital account, crediting the capital account. Through these first four closing entries, the only thing we've done is closed out the revenue accounts by transferring their balance to income summary, closed out the expense accounts by transferring their balances to income summary, and then we closed out the balance in income summary to the capital account, ultimately transferring the total amount of income to the capital account through those first three closing entries. The last closing entry will close out the drawing account. The owner's drawing account has a $2,000 balance. Drawings have a debit balance. Thus, to close them out, we will credit the drawing account for its balance of $2,000. We will directly close the drawing account straight into capital by debiting the capital account. That debit will decrease the capital, which reflects the amount that the owner has withdrawn out of the business, decreasing the owner's capital, decreasing the overall owner's equity. Let's see the impact of those transactions in P accounts so we can visualize what happened. Revenue account had a credit balance of $50,000. We debited that account for $50,000 in the first closing entry, bringing its balance to zero and transferring the amount of revenues over here to income summary. The second closing entry credited the expense accounts. So here we're seeing a credit to the expense account, offsetting its debit balance, and a credit to the supplies expense, offsetting its debit balance, leaving them with zero balances. Total amount of those expenses were debited into income summary, $31,000. That left it with $19,000 balance. The third closing entry then debited that account for $19,000, essentially zeroing it out because the debits of $50,000 offset the credits of $50,000. Finally, the last closing entry took the balance in the drawing account, credited it, and credited it directly to the owner's capital account. So through those first closing entries, we ended up ultimately transferring the amount of income into capital with the credit, decreasing that capital account with a debit from the drawings, leaving an ending balance in owner's capital of $47,000. Let's do that same closing entry process in this example. We're going to start with an adjusted trial balance as opposed to just having the temporary account balances given to us. Scotia Company had the following adjusted trial balance. Now remember, the trial balance is simply a list of all accounts and their balances at the end of the accounting period. We are going to prepare closing entries as of June 30th of 2010. Okay, so we're at the end of the month of June 30th. These were their adjusted balances. We want to close out those accounts. What we need to do is 4 closing entries. The first entry we're going to do to close out revenues. Looking through their adjusted trial balance, we have one revenue account. It has a credit balance. To clear out that credit balance, we need to debit the revenue account. So our first closing entry will debit service revenue for its balance, and we transfer that account to income summary. The second closing entry will close out expenses. Here we're seeing 3 expense accounts: salaries, miscellaneous, and supplies expense. They all have debit balances. To get rid of their balances, we will credit them. Here we are seeing those 3 expense accounts being credited for their balances. The total amount of all expenses being transferred out of the expense accounts goes into income summary with a debit, $3,828. In this first closing entry, we credited income summary for $4,064. In the second entry, we debited that account for $3,828. The difference between the credits of $40.64 and the debits of $3,828 leaves a balance on the credit side of $236. The third closing entry will close out that credit balance by debiting income summary for the balance of $236 and transferring the income, which is really what's in income summary, the revenues and expenses. The difference between them represents net income. We are debiting it out of income summary to clean out its balance and crediting it into capital, thus increasing the capital account for the amount of net income for the period. The fourth closing entry will be to close out the owner's drawings account. We can see at the end of the month, the owner's drawing account has a $300 debit balance. To close out the debit balance, we need to credit that account. We will credit Scotia's drawing account for $300, and we will transfer that amount of drawing directly into the owner's capital account with a credit of $300. By doing this, essentially what we've done is transferred the revenues and expenses and the owner's drawing account into the owner's capital account. So after those 4 closing entries are posted, all of these balances will be 0, and all of those balances will be wrapped up and transferred into this owner's capital account. If I were to prepare a post-closing trial balance, we will see that only the assets, liabilities, looks like they snuck a liability down here on us as well, and the owner's ending capital balance have any balances left in our post-closing trial balance. We could have these other accounts listed here, but their balances would be 0, so there's no reason to include them in the post-closing trial balance. right, let's pull it all together and do one more problem. We are going to be given a worksheet, and our job will be to complete the worksheet by extending the balances to the financial statement columns. Then we will prepare financial statements using the data from our worksheet financial statement columns. We will journalize the closing entries into the general journal, assuming all the accounts balances are normal, what we expect them to be. We will then post the closing entries to the general ledger, and then prepare the post-closing trial balance from the accounts in the general ledger. We are given here the adjusted trial balance at the end of the year 2013. This means that all accounts have been adjusted. We are ready to prepare financial statements. In order to prepare financial statements, what the worksheet does is makes it super easy for us to differentiate what accounts go on the income statement and what accounts go on the balance sheet. Looking down this list, cash is reported on the balance sheet. It's an asset. Accounts receivable, an asset reported on the balance sheet. Prepaid rent, an asset reported on the balance sheet. Supplies, office equipment, accumulated depreciation. All of those assets are reported on the balance sheet. Accounts payable, a liability, is on the balance sheet. Owner's capital will end up on the balance sheet. Owner's drawings, ultimately it will end up on the balance sheet by being wrapped up in the owner's capital account. Revenues and expenses go into the income statement column. All the worksheet did was take these account balances and transfer them over to the column where they will be reported, either the income statement or the balance sheet. That makes it easy for us to now prepare the financial reports without missing any of the accounts. Notice that when I total up these columns, they no longer equal. It's because I have kind of split these up amongst the income statement and balance sheet. Here we're seeing the credit balance of revenues is greater than the debit balances of our expenses, which we kind of expect because the difference between revenues and expenses is our net income. Over here, we're seeing that the debit balances are greater than the credit balances in the balance sheet. And the reason is because the difference between those two of $26.95 represents all of the revenue and expense balances that are being reported on the income statement. Those have not yet been included into the owner's capital ending balance because we haven't closed those balances into that account yet. That's what we need to do with our closing entries. Before we do our closing entries, let's prepare the financial statements. Let's prepare the income statement first. Revenues and expenses to report our net income. So here's our income statement reporting our revenues and our expenses, leaving us with net income of $26.95. Revenues minus expenses leaves us with income. The next statement we prepare is the owner's equity statement. Look at the balance that we report for beginning owner's capital. It is the same balance that is currently recorded in the general ledger and reported on our trial balance. That is simply because this balance has not had any of the revenues, expenses, or drawings amounts recorded in it. We have been recording drawing transactions, revenue transactions, and expense transactions into those temporary accounts. So this is the beginning owner's capital account balance. The beginning of the year, we started with $75.55 and nothing has been recorded in there to change it during the year. So we start with $75.55. Owner's capital is increased by the amount of net income. Our net income comes right out of our income statement, which is why we prepare the income statement first. We have a subtotal here. Then we subtract out drawings. And here's the owner's drawings, $3,000, leaving us with an ending capital of $72.50. Next, we prepare the balance sheet. This is where we report our assets, less the contra asset accounts, our liability, and our ending owner's capital account. Here are the assets. And actually, let me put this all onto one page so it's easier to see. Here are the assets, less the accumulated depreciation, the contra asset account, leaving us with total assets of $74.50. Here's our liability account and our ending capital balance that comes from the owner's equity statement, $72.50. Total assets equal total liabilities and owner's equity. All right, we have now prepared the financial statements. We now need to prepare closing entries. We want to get the accounts ready to start recording transactions of the new accounting period. The only accounts that we close are the temporary accounts, revenues, the expenses, and the owner's drawings accounts. We want to close those balances into the owner's capital balance. The first closing entry closes out revenues. Revenues have a credit balance. To close them out, we will debit it. We will transfer the total amount of the revenue into the income summary account with a credit. Next closing entry will close out the expense balances. We have 4 expense accounts. Each have a debit balance. To close out those debit balances, we will credit those 4 expense accounts. Total dollar amount of those expense accounts is transferred into income summary with a debit. After those first 2 closing entries, we will have credited the income summary account for $7,700. The second closing entry would have debited it for $5,005. That $5,005 would have offset that credit partially, leaving a balance of $26.95 credit in the income summary account. If it has a credit balance of $26.95 after the first 2 closing entries, we need to close it out by debiting it $26.95. And then we will transfer the amount of income into the owner's capital account with a credit, increasing the owner's capital account for the amount of income for the year. Our last closing entry will close out the owner's drawings account. It has a debit balance in the general ledger. To close it out, we will credit the owner's drawing account and transfer the amount of the drawing directly into Northwood's capital by debiting capital, thus increasing the capital account by the amount of the owner's drawings. We post those closing entries to the general ledger. We will debit the revenue account for $7,700. Going down here, we find the revenue account. Balance before closing, closing entry, leaving it with a 0 balance. Take the post reference back up to our general journal. Then we credit income summary for $7,700. Income summary now has all the revenues temporarily recorded in there. Our post reference back up here. Then we go to our next line. We need to debit income summary for the amount of expenses. Here's the debit, decreasing its balance down to $26.95 because it did have a credit balance and the debit offset it. Bring our post reference back up to the general journal. Then we are going to, and I'm going to do these all at once, we're going to credit all of the expense accounts for their balances. So here we are crediting depreciation expense, offsetting its debit balance to zero. $60 credit balance in rent expense, offsetting its debit balance to zero. Same thing for salaries and wages and supplies expense. I'm going to take each account's post reference or its account number back up to the general journal. Notate that those have been posted. After those first two closing entries, let's take a look at what's in income summary. After those first two journal entries were recorded, or the first closing entries, we're left with the credit balance and income summary. So now we are going to close out income summary by debiting it and crediting Northwood's capital. Here is income summary being debited, which offsets its balance, bringing its balance down to zero. And here's the credit into the capital account, increasing its balance from $7,555 up to $10,250. Bringing my post reference back up to the general journal. Last closing entry, let's close out the owner's drawings account by crediting the account to offset its debit balance, bringing it down to zero. And we will transfer that $3,000 directly into Northwood's capital by debiting that account, thus decreasing it down to reflect how much of the owner investments and income has been withdrawn by the owner. We will then take those two post references back up here to the general journal to notate that those have now been posted. So after the closing entries have been posted, only accounts with balances in them are the asset accounts. Supplies, office equipment, accumulated depreciation. Where did our liability accounts go? They must have put them down below. Nope, didn't have our liability accounts in here. Here it is, sorry, I missed it. Accounts payable. So our only accounts with balances are the assets, the liabilities, and the capital account. Drawings account, income summary, revenues, and expense account balances are all zero. Any amounts that have been recorded in them have been transferred to the owner's capital account. So when we prepare the post-closing trial balance, the only balances we have to report are the permanent accounts, or the accounts that keep their transactions in them permanently. What this means now is that when we start recording transactions in the new accounting period, the temporary accounts will only be recording and reporting revenue, expense, drawing transactions within that new accounting period. We won't be intermingling revenues, expenses, and withdrawals or drawings between two different accounting periods. All right, reach out if you have any questions.